What's going on, everyone? My name's Lior, and I'm a real estate investor out of Boston. And in this video, I wanted to talk to you guys about the one flaw of the BRRRR strategy in expensive markets. So if you guys don't know about me, like I said, I'm an investor out of Boston, and I've used the BRRRR strategy as one of my main strategies in order to grow out my current rental portfolio. Today, I own up just about $9 million in rental property with my partners. And BRRRR has been amazing, right? And if you guys don't know what BRRRR is, basically it's you're buying property, you're gonna rehab them, rent them, and then refinance them, and ideally repeat once you refinance the cash out. Now, the way we've been able to structure our business is, obviously, again, we play in a very expensive market, which is Boston. It'd be very hard for me to come up with a 25% down payment on these, $800,000 to $1 million acquisitions over and over again. So what we've been able to do is essentially raise that equity that we need from private investors and work with them, right? And again, the theory behind the BRRRR is, in an ideal world, when you do this sort of project and you get to that refinance stage after the property is completed and rehabbed and rented, and it's worth hopefully a lot more, you are able to refinance, take cash out, and pay that whole initial equity investment back, right? And that's the issue in expensive markets, especially like Boston, is because Boston is, and I'm talking about within a few miles of Boston, right? Obviously, once you go outside of Boston or any major city, I'm sure it gets a lot cheaper very quickly. But when you're playing in these really core markets, not only is the competition level absolutely insane, right? But the way the pricing is so high here that it becomes very hard to do what I call that clean BRRRR, right? Where when you refinance, you're able to pull enough cash out to pay your investors back. So let's just put some example numbers behind this just so it makes a little bit more sense, right? Let's say I'm buying $1 million building, and in order to buy into this $1 million building, I need to raise 25% down of the purchase price, which would be $250,000. Now that's great. So I partner up with someone that gives me the $250,000. I operate the deal. We're able to rehab it, rent it out. It's worth a lot more. And now we get to the refinance stage. The issue with, again, an expensive market like Boston is because the pricing is so high on the front end, right? Because of that, it's pretty rare where we can refinance enough money out to pay the investor back completely, right? So if they lent us $250,000 for equity, maybe on the refinance, we can get them $100,000 or $150,000 back. But it's pretty rare to have that clean BRRRR that you might have read online on sites like BiggerPockets or whatever it is, where you can get your investor back 100% of their money. It's just very, very hard to achieve. And I don't think I've seen actually anyone be able to achieve that in the core markets around Boston. So, I mean, we've had to become a lot more creative with this. And it starts with being upfront with your investors, right? So whenever I underwrite a deal or whenever I pitch a deal to investors, I always like to talk about how much money what we really think the building is going to be worth once it's finished, right? Once we rehab it and rent it out, and how much money we can reasonably think we can cash out on the refinance and pay our investors back. What that also means is your investors are going to have to be comfortable with the idea that, hey, I'm going to lend you X amount of dollars. I know I won't get all of it back, but I'll get maybe some of it back. But I'll retain my position in the property. I'm still going to get, hopefully you can show them that they're still going to be able to get some sort of cash flows, right? So that it'll be making money on a monthly basis. So that, again, it's still an attractive proposition for your investor. But regardless, your investor is going to have to be more of what I call a patient investor, right? Because again, if they're not going to be able to get their whole recoupment of their investment back within the first, say, 12 to 18 months, they're going to need to be comfortable with the idea that, hey, some of my money might still be locked up in this project until these guys exit, which is sell the building. Now, this kind of leads me to the next point is when I propose these kinds of deals, this is one of the main reasons why I personally like to only show projections of up to 3 years on our projects, right? Because 3 years is kind of, I think, just long enough where people want to see, hey, if I need my money back at year 3, right, and that's like still a pretty long time, show me what the numbers are going to look like, right? Because by then, they're probably going to want their cash back. And if they're in the situation where they tell you, hey, you know what, at year 3, we can keep investing in this building. We don't need to sell. We can just hold on to it. I like the building. I like the area. I like how it's performing. You can obviously always hold on to it and just keep on riding, right? But I like to be upfront with investors, and this is the key, right? You got to be upfront and show them exactly the scenarios you're thinking of. So I like to be very upfront with them and tell them, look, it's unlikely I'll be able to get you all your money back within the first 12 to 18 months, but this is why we have a 3-year plan. If at year 3 you need your money back and there's no way for me to get it to you in any other way, right? Whether I buy them out, maybe bring in another partner, whatever it is, I'm going to be comfortable selling the building. And that is exactly why, like I said, we do 3-year projections. So the main point of this that I wanted to really get across is be upfront with your investors, guys, right? Whatever your business plan is, whether you can do a clean BRRRR, whether you can't do a clean BRRRR, which again, if you're playing in expensive markets, pretty unlikely. You want to be upfront with your investors about when they can recoup their investment back, what the timeline is, and what the expectations are. If it's going to be that scenario where you're not going to be able to do the clean BRRRR, right, where you give them all their money back, you want to be able to show them how much money you think you can get them back, right? And then what are their cash flows going to be in the meantime, right? Because they still want that money working for them. So they would probably want some sort of cash flows coming in from the rental building while you guys are still holding on to it. But that being said, if you guys are honest about that upfront and you can find an investor for that, an investor who likes that kind of strategy, this is an amazing way to grow your rental portfolio, even in an expensive market, right? I mean, this is really the key. A lot of people typically say, well, in these really expensive markets, it's so hard. You need so much money and all that. And it's true, but you just got to figure out a way to make it a win-win for both you and your investors. So hopefully that makes sense, guys. One other thing I'll do in the comments below, I'll throw out like kind of a little cheat sheet, just outlining some sort of scenarios about a clean BRRRR versus not a clean BRRRR, so you can kind of get a better feel of the numbers. But if you guys have any questions, any comments, throw them below.